Hello and welcome to Pro Trader Strategies Market Commentary for Monday, June the 12th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, let's get this on. Not a whole lot of economic data today coming out, as it being a Monday, usually pretty quiet for economic data here in the United States anyway. But I do have a lot to go over, so let's get on with it because I've been pretty busy this morning. With crude oil futures, getting a nice little bounce after finding support on the 61 Fibonacci level, pushing a little bit higher. Covered a little bit of my XOP, which I'll talk about here in a little bit based on that bit of a move there. And then gold futures. Gold futures are coming off a little bit, despite the fact that we're seeing the equities come off too. So usually the flight to safety would show up in either gold or the bonds, and we're not seeing either of those happening, with the bonds being down, or actually bonds are slightly up on the day as well. But the fact of the matter is you would expect it to be a little bit more if there was real fear in the market. I still consider this wanting to go back down a little bit the closer we get to the FOMC. They might be taking out some of that rate hikes, but at the end of the day, it's not really a flight to safety, I would have to say. We got the Dow Jones Industrial Average down 74 points right now. Just can't get through this value area high, so that is acting as a major resistance right now. But the Dow Jones negative on the day, as well as the NASDAQ down quite a bit today, has come off of its lows for the most part, and was even a little bit higher. It's kind of had a tendency to slide off here, but I think that we're going to be finding a little bit of support, as it looks like some of the tech sector is turning around a little. Then we have the E-mini S&Ps off by just a little over 7 points inside of yesterday's range when we kind of sold off and bounced back at the end of the day. We are kind of filling in some of that volume from Friday. Remember, Fridays are really synonymous with flight to the Hamptons. A lot of these guys after lunch kind of take off and head out for the weekend. So we're seeing some of that volume fill in right here, as you can see, close to the lows of the day, but at the end of the day, we are just inside of yesterday's range still. Now on to a few things that I've done. Now this trade I actually took off on Friday late in the day. It's actually looking a lot better. If you've still had it on, I probably could have covered it much better than I had. But I had on the June 62.5 calls that I had sold, and originally I collected 71 cents, bought them back for $2.53. Now this is something that I probably should have been a little bit more diligent on, because as you can see, this really had a trend going down, right here, and I should have covered that trade. Kind of lost track of it as soon as we broke out of here, but I kind of lost track of this trade for some reason. It was I put it on pretty small, but that was a misstep by me. Then on to Apple. Apple is a trade that I had on as a synthetic long. If you remember, I basically had it on as a synthetic long from the 155 strike, and I had on the January, I had bought the 155 calls and then sold the 155 puts, and originally did it for a debit of, or actually a credit of 70 cents, and I got out for a debit of $9.73 for that matter. But if you remember, during that time when I started seeing this trade go against me, I started getting mechanical with it, and I had sold the June 160 calls for 87 cents, bought them back for 43, and then I had kind of basically a day later decided to go in and sell the June 165 calls for 74 cents. Now I still have those on, letting those decay because I don't think that I'm anywhere close to getting those 165 calls. So that covered call strategy in a sense. But today I went into the July and sold the 135 puts for $1.43. Now why did I do that? Why did I get out of the synthetic long and into these puts? Well, I kind of put on a higher probability trade is the way I'm looking at it, trying to recoup some of that loss. And I covered that synthetic long a little bit earlier, and then decided when I started seeing this pullback in Apple, after I pulled the ripcord on it, decided, you know what, it's got high implied volatility, as you can see here, earnings coming after that cycle, so it shouldn't really be affecting me that much. Allows me to get a little bit further away, and selling those 135 puts is way down here. So put on a higher probability trade, taking advantage of the high implied volatility, and decided to get out of that low probability synthetic long trade. Then on to NVDA. NVDA is a trade that I just put on today and went into the July, sold the 125 puts for $2.02. Now why did I do that? Again, this is what I was talking about. A lot of these techs were getting really beat up on Friday, so today we're getting a little bit of a bounce, trying to take advantage of a lot of this high implied volatility in some of these, kind of getting back to what I love to do, and that's selling premium, and this is giving me the opportunity. We're getting a lot of these names up to the top of the list, so putting on high probability trades, which is why I've been so busy today. And then the Qs, another similar situation. As you can see, the Qs have high implied volatility as well. This meets my the rules of taking advantage of high implied volatility. It was up in the 60s earlier this morning. I'm trying to just check and see where they are right now. 63 implied volatility percent. So looking for a little bit of a bounce. They were the ones that really kind of were tanking on the downside, being the NASDAQ, and trying to take advantage of some of that high implied volatility. So I sold the July 131 puts for $1.13 in there. And then on to XLK, which is the technology sector, again, trying to take advantage of this move and high implied volatility. They got beat up, so being a contrarian, looks like they found a little bit of a bottom here. I actually put this on earlier this morning and sold the July 53 puts for 58 cents. So those 53 puts gets me below this support level, which is going to be the value area high. That's going to act as support. If we get back down here, you can see that it had consolidated here. It also looks like, this is going to be a support area right here as well, with it bouncing off of that 50 moving average. So then on to, since I've got so many, I got to start trying to pull these off this way. XOP I had on the June 52 puts. Originally sold them for 47 cents, covered them today for 23 cents. I still have on those July 30 puts in XOP, but I am working to try and get out of those 30 puts. It's a little bit of ways away from me. I'm trying to get out for 29 cents. It's trading around 37 right now. And then on to the next trade that I put on today was in, I actually took off Nugget. Let's see, Nugget, which is the, as you can see, the gold miners, 3 times bull ETF. And I put this on with high implied volatility, if you remember. So I went into I had gone into the July and sold the 50 calls. Now, when this went against me, remember, implied volatility started expanding, went down. I'm short the, I was short the 50 calls, and the market rallied up to right around in here. Now, I wasn't really getting close to my 50 calls, but because of this expansion in volatility in Nugget, I was able to add a few more of those July 50 calls. So I originally sold them for 97 cents. When we got that little bit of a pop, volatility exploded in there. I sold some more 50 calls for $1.35, which put my average right around $1.13, with implied volatility crush coming and directional move in my favor. Came off, bought them back for 53 cents today. So took advantage of a little bit more implied volatility, got some directionality. Those 50 calls were way up here, so I was short those. Didn't have to really worry about it, but with the expansion and volatility, that was hurting me, so I decided to add some, if you guys remember, along those lines. And then another trade that I added was Boeing, and what I did with Boeing was looking a little bit worse today, thinking it was looking a little bit at topish, and decided to put on this El Loco Azo, which is the opposite of the El Loco Toro, which I did a webinar on Friday. I'm going to do the El Loco Azo on Friday, which is basically a bear spread or a double bear spread. Basically what we're doing is selling a call spread to finance a long put spread in there. And so what I did in this trade was went into the August and bought the 185 puts and then sold the 180 puts. And then to finance that long put spread, I went in and sold the 190 calls and bought the 195 calls. So that 190, 195 call spread financed my 185, 180 put spread, and I collected a credit for 60 cents. So if I get a bit of a pullback there, that trade will look pretty nice. It's pretty tight on those wings there, as you can see with the put spreads. I need it to come down to around 185, which would be this support area. So looking for that trade, as you can see, it made a top here that should act as support going across the board there. Then on to American Airlines. Just because I wasn't completely sure with this, I decided to kind of set this up as a pairs trade. It does look pretty bearish. When I did this, it was looking like it was going to come in below this value area high, and once we kind of trade back into that value area high, I would expect it to come down to this node here, which is a point of control for American Airlines, ticker symbol AAPL. So with this one, I decided to go into the August and bought the 50 puts, sold the 47 puts, and paid a debit of $1.39 for that trade. So that is inside my rules for that trade. We got low implied volatility, paying less than 50% the width of those spreads, and set it up so that if it comes down and trades to this 47 area, that would be a point to cover that trade if I can get down there and get tested on that. And then on to Gilead, TILD. Gilead's another trade that I added on today, and was looking a little bit better as well this morning. So I put on an August 72.5 call spread and paid $5.48 for that. So that being a $12.5 wide spread, again paying a debit for that, less than 50% the width of those strikes. So looking for Gilead to come up and trade closer to this point of control here, which would be a full winner on that trade if I can get it up to that 72.5. But I'm in just slightly lower than that, so I would like to see Gilead break out of this massive downturn. Plus we're looking at like tweezer bottoms here, so this is really acting as a nice support area down here. Not loving this candle, but it was looking a lot better earlier this morning. I can guarantee you that. Anyway, on to AT&T. This is a trade that I took off and just recently decided to pull the ripcord on it, and had on the July 41.35 put spread. Originally paid $2.21, or sorry, what did I do with the AT&T trade? With the AT&T trade, I sold it for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. 37 cents. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So I bought the 41s, sold the 35s, actually, and then paid $3.37. Got out of that trade for $2.21. So actually I paid $2.71, got out of it for $2.37. So that trade was a loser. Just trying to figure out exactly what my loss was on that trade right now. I think I wrote it down incorrectly. Yeah, I paid a debit of $2.76 for that. Sorry about that, and sold it out for $2.37. So bit of a loss on that trade there. So got everything out of the way. A lot of trades put on today and taken off. Got to be able to take advantage of some high implied volatility today, which was the catalyst for a lot of my trades. All right, so Friday's webinar, like I said, is going to be on the double bear spread or the El Loco Azo. So check that one out. That's what we used to call it on the floor. Just a bit of fun. Everybody kind of comes up with some names of different things. The reason why we call it that, it's the local bear, loco bear, or the crazy bear, meaning a double bear spread for a big move, because you want that move to really happen. All right, that's all I got for you guys today. If you can't take that, take it easy.